According to CBS, inflation erodes wage gain. Even six-figure money earners right now are feeling the strain on finances due to the increase of inflationary values of everything around us, from commodities to homes to cars, everything that we're looking at and you guys have all witnessed over the last couple years. Right now, as Americans, what CBS is stating is that more Americans are living month to month, paycheck to paycheck than even before. So if that's the case, 74% of our US population pre-pandemic was living paycheck to paycheck, month to month, and now over 81% of US Americans are living paycheck to paycheck, month to month, and they have more bills left at the end of their paycheck. And so what's happening is our national debt is growing in spite of wage gains, and the US American people are feeling more compressed and more broke than ever. Now, how does this affect the housing market? And so what I really want to talk to you guys about today is how the housing market is being affected. Is this a massive effect on what's happening? And so let's unfold it. Let's take a look at what Zillow numbers actually look like, and let's actually take a look at the National Zillow Home Value Index to depict where home values are. And at the end of this, I'm going to let you guys know how Redfin either supports or they deny what's happening with Zillow. Now, one of the big things that the National Zillow Home Value Index states is that month over month, year over year, we have seen gains over the last 12 months. And so if you look at the year ending in November of 2022, coming from November of 2021, the Zillow index states that we've seen a 10.4% value increase over the last 12 months in single family residences. And so if home appreciated values have went up 10.4%, where are they today? And what's happening to them currently with the current market conditions? Now, we turn on the television and all of us are hearing that home values are dropping, that there's a compression in the market, and with everything happening with inflation and high interest rates, home values are being affected. But when you look at it month over month, and you look at what they're talking about year over year, the Zillow predictions were actually predicting a 2.8% increase just a few months ago. They have since softened their predictions, and now what they're predicting is a 1.1% year over year reduction in house prices going from November of 2022 leading into November of 2023. So when you look at the whole scheme of things, that's the annual year over year, not month over month, year over year. And so how does that affect home values, home buyers, and what's happened? So right now, we have over $11 trillion of equity in single family residences nationwide. And so home buyers right now are sitting at a really good place for those who have closed, stabilized, and are living in their single family homes. When they have equity of over $11 trillion, what that means is that the US population right now still holds a lot of capital within their single family residences. Hence, that's why home remodels are actually stimulated right now, and the American people are spending for those who actually have purchased real estate and are holding that $11 trillion in equity. So in spite of wage increases and inflation affecting the average US American, the home buyers that have actually been able to get into real estate and hold that equity are actually sitting at a really good place, with projections looking for next year that there's going to actually be a decline economically in the appreciated value of homes of 1.1%. As bad as that is, it's not as bad as the whole scheme of things when you look at it. Let's take a look at numbers. Let's ask Google, what is 1.1% of $11 trillion?
The answer is 121 billion US dollars.
So home values will depreciate nationwide. We will lose 121 billion US dollars in equity over the next year in real estate. Now, the question is, not everybody's going to lose their real estate, and in all honesty, appreciated values still supersede the national average of our annual basis of what real estate appreciates annually. So if the annual average is 1.8% increase, and we've seen a 10.4% year over year, even in a bad economic year like 2022 has supposedly been, we're still sitting at a very good place. So next year, if we see a decrease of 1.1% due to high interest rates and everything that's happening economically, understand that we're still sitting at a place where values are still sitting higher than the average. Now, we will compress the market at $121 billion worth of equity that'll disappear someplace. And for those of you guys that are paying attention to the market, that's where opportunities will lie. How much of that $121 billion will you utilize to be able to pick up and take advantage of putting into your portfolio as discounted real estate prices and being able to put towards equity in holdings that you'll end up being able to either sell for profit or hold and retain that equity long term for long-term depreciation and cash flow. And so the biggest thing for investors right now is to understand that the market is declining. For end home buyers and those people who are looking to be able to sell their home, this might be a good time to hold, retain, and see what happens over the next 2 years. As we move into an election year in 2024, historically, election years are really good years. They're years that the presidency, especially in a 4-year term, wants to be able to look like they're the king, they're the hero of fixing our economic distress. And so in election years, usually the president and the whatever party it is, Democrat, Republican, are raving about how they fixed this economy that was otherwise compromised. So as home values actually go down slightly, you investors, listen up. This is your time. Now, people ask me, they say, Jerome, how do you feel about the increase in interest rates? And I keep telling people to embrace the interest rate increase, because as interest rates increase, values of homes will continue to go down. Now, $121 billion is still a large number, but when you distribute that equally amongst all people in the United States, it's a very small number. But when you compile that and actually only discount that to action takers, it's a large number in your back pocket and your portfolio. Now, one thing that's extremely important to know is where to buy. And so for those of you guys that are interested in knowing where people are moving and understanding where to invest your capital, here's where. Look, if you guys like content just like this, smash that thumbs up button, subscribe to our YouTube channel, and let us know. Comment below and let us know what type of content we can produce for you that's related to investing, real estate investing, and the U.S. market and economy as it relates to real estate. One thing I promised you guys is to disclose how Redfin fits into the Zillow predictions and where they feel things are migrating. But before we go over that, let's understand what are the most popular cities to be able to invest in right now. So one of the big things is statistics have shown where people are actually moving right now, and they're moving from metro to metro area. In fact, over 24.1% of home buyers look to move into a different metro area over the next 3 months. That's a record high over the 18% pre-pandemic number of people moving from one metro area to another metro area. But where are they going? So according to Zillow, the number one area that people are moving to right now is Sacramento. Number 2 is Las Vegas, Nevada. Number 3 is Miami. Number 4 is Tampa, Florida. And number 5 is San Diego. And one of the big reasons that people are moving to these areas is because it is the Sun Belt of the United States. So people are migrating from other areas into the Sun Belt. And now Redfin is sitting back and they're going, look, we confirm that what Zillow is saying is accurate and true. And our predictions lay parallel to what Zillow is actually talking about. And yes, people are migrating to the Sun Belt, and inflationary values are still at a really solid standpoint in these cities. So investors, listen up. If you can take advantage of the distressed prices in these areas, these cities will be the migrating cities of large increases once the market stabilizes. And so where you find financial distress, there's always opportunity. And one of the big things that we did in 2008 is we migrated to the worst and most affected cities across the United States. We had no idea that the economic turn was going to allow these cities to go up in value exponentially. Phoenix being one of them, Las Vegas being another one of them. With all the economic growth that's happened nationwide in some of the largest cities across the United States, including Sacramento, Las Vegas, Miami, Tampa, San Diego, home values will continue to rise. The desire for end users to move to these cities is going to continue to grow. Ladies and gentlemen, we're sitting in a market that's unprecedented right now, but we're sitting in a market that actually came out of one of the strongest economies that we've ever seen as a U.S. economy. And so understand, in spite of how gloomy it looks on the back end, there is light at the end of this tunnel. 2023 is going to look extremely grim for those of you guys who only look at it from a selling perspective and a non-investment perspective. For those of you guys who embrace every aspect of this downturn economy and take full advantage of the discounted prices of real estate, you will not have to worry about interest rates being high. You will not have to worry about compressed cap rates. You just have to understand that historically, as markets decline, things always recover. Look at history back from over 100 years ago and every decade from there forward. And understand that if you invest today and understand how to pick up real estate at decreased values, you, at the end of this recessionary market, will benefit immensely. Click below, give us a thumbs up, subscribe to our YouTube channel, and I look forward to seeing you next time.